Welcome to the next episode of Just Peachy. I'm Peachie Thompson and I'm your host. Just Peachy is a show where we interview leaders and subject matter experts in the fields of insurance, finance, and taxes. We also have a lifestyle section where we talk about anything and everything under the sun. Today, I am so excited to introduce to you to our next speaker. He is the founder and owner of ACH Wealth Management. He has been in the financial industry for over 25 years. Please welcome Mr. Adam House. Adam, thank you so much for joining us today and welcome.
Thanks for having me, Peach. It's great to be here.
Yes, Adam. So I always love to start by asking my guest speakers to tell our audience, to tell us a little bit about yourself, your journey, how you got to where you are right now.
Well, thanks, Peachy. It's been a long and very interesting road. I think I've covered a lot of different territories when it comes to finance. I've always been a numbers person, but I've also been very much a people person. So I actually started out considering doing corporate law or finance. And I worked in stock research for a firm in Washington, D.C. in the 90s. And I worked for a law firm in Washington, D.C. in the 90s. And neither one really appealed to me that much, to be honest with you. I wanted to do something where I was working with clients on a day-to-day basis and helping them solve problems and also be closer to the stock market, which in the 90s, as you know, was on fire with the internet boom. Those were very, very exciting times. And the ability to use the internet to manage assets. So those two came together at the same time and lured me into becoming a stockbroker in the 1990s with a firm called Waterhouse Securities in Northern Virginia.
All right. And you now own your own firm.
Yeah, that's right. It has been quite a road. I've managed 3 offices for a brokerage firm. I have worked at a large investment firm, Merrill Lynch, and I've spent 7 years in the 403B space working with teachers and other educators here in Gainesville, Florida, mainly with the University of Florida, with TIAA, Teachers Insurance Association of America, Annuity Association of America, formerly TIAA-CREF. And, you know, the pandemic affected people in many different ways. One of the ways it affected me is I kind of moved forward with my plan to go independent and start my own firm as a fiduciary. And so I've done that. And now I am working with clients, limited number of clients versus how many I used to work with before, and doing comprehensive financial planning.
Fantastic. And you are the right person to talk about what we're going to talk about first here. I know we have so much that we want to cover today, but let's get started with college, right? College is very expensive. There's, as you know, there's the debt forgiveness recently, but we're not really going to talk about that today. I'm interested to hear about your thoughts on Florida prepaid college tuition plans to cover college costs.
Yeah, that's such a great, important topic. The costs are absolutely staggering. And it's hard to imagine any parent who has children they expect to go to college who isn't concerned about their ability to pay for the college or the amount of debt that their child is going to have when they come out of college. And the cost of college is accelerated on an annual basis at nearly 6%. And as the limits for loans have risen, so universities have decided to raise tuition in lockstep with those new loan amounts to just increase the amount of debt that students graduate with. And that can be an incredible hindrance for so many years. And when you're that age, 18, 19, 20, the fact that they give you the ability to borrow that much money is kind of staggering. It's the only time I can think of that no credit rating, no job, no income, no problem. We'll just give you as much as you need. And at that age, you don't really understand the consequence of carrying that debt load for that long and the effect it has on buying a car or buying a house. And it's something that if you can get in front of, it's something you could at least reduce, if not eliminate almost completely. You know, we grew up with our parents' generation telling us they used to work their way through college. I'm not sure I know any student that could make $50,000 a year part-time these days. And those days are long gone. And a lot of people aren't using the GI Bill. So what do you do instead? You can obviously invest in the market on your own and save money that way. And you may be very successful with that. You're going to have to do very well, though, and you're going to have to do very well for a long time. And also, you're not going to have your gains aren't going to be tax deductible when you use them for higher education if they're just in a brokerage account. And if you're funding it from a retirement account, you may have to borrow against that retirement account, or if you make withdrawals from that retirement account, you may have to pay taxes on them. Neither of which is optimal.
No. Mm-hmm.
So there are alternatives. There's the 529 plan, which replaced the Coverdell Education Savings Account. For those of us old enough to remember the Coverdell Education Savings Account, you couldn't put very much money into it. I think it started out with $500 a year. I don't know what college you're going to with that amount. Then they increased it to $2,000. Still wasn't, satisfactory. So the 529 plan was invented to put money away, and then if used for higher education expenses, secondary education expenses, then it would be tax-free. Sounds great. Again, you're taking some risk than if you're involved in the stock market. I'm not saying don't do that, but it would be on you for most to decide what investments to make. Some of the states have, and they're all state-driven, some of the states will help you basically invest now based on the age of your child, and then make the investments more conservative as you get closer to college, which makes financial sense when you think about, well, I don't want to have a huge reduction right before I go to school. But when you think about it, the amount of time when you have the potential for the most gain in the early stages of investing is when you have the least amount of money invested, unless you're able to put a huge lump sum in, which I've rarely, if ever, seen. Sometimes grandparents step up and make big deposits into 529s, but that's pretty rare. So Florida, fortunately, in our state, we have an incredible program that allows you to lock into the cost of colleges today, for your child, which is amazing. So you can register with Florida 529 plan. They will tell you what the payments will be every month based on the program you want to choose. That can be a 2-year school for 2 years and then a university for 2 years. It could be a 4-year university. You can include expected costs for dorms. It's up to you. There's a lot of flexibility. And you would make those payments typically on a monthly basis, although you could pay more upfront if you wanted, or more as money came available to you. But then you know exactly what you're getting at the end of the day, and that you'll be able to, if your child's accepted, of course, go to Florida college or university in the state with the tuition covered. It takes a tremendous amount of market risk out of the equation. There's a lot of discipline involved in 529 savings, which sometimes it just becomes the last thing that people do because they don't feel like they have the money for it. This puts you on a set path, monthly expenses automatically deducted, no market or interest rate risk. You know exactly what you're getting, and they keep track of your payments. And at the end of the day, when your child is ready to go to school, they have tuition covered.
So it sounds really great. What are the, disadvantages of this, right? Are we limited to Florida schools because it is a Florida prepaid college tuition plan? Or if my kids are Floridians right now, but they decide, or they get accepted to schools outside of Florida, can I use the plan?
You can. That's the number one question. What happens if my child goes to school outside of Florida?
Yeah.
Or leaves the state? So they would take the average cost of the schools in your plan. If it's a university plan, what's the average cost that has been covered with all your payments? And that can be taken to another school out of state, private, or state. So you can take that money to that other institution. It may not cover all the costs of that other institution. In fact, it'd be unlikely to if you're going out of state or to a private school, but you would still have that money. You haven't lost anything, quote unquote. You haven't lost any money, and you would still be tax free. And if your child doesn't go to school, that money can be passed on to another relative without any issue. It's extremely flexible. So those are the two biggest questions. What happens if my child doesn't go to school? What happens if my child goes to school out of state?
Yes. And so, Adam, as you and I both know, throughout our lifetime, there are changes. Sometimes you lose your job, you move, say the whole family, the breadwinner loses the job, and this is debited from the account, right? What happens if we need to choose between putting this money aside versus paying for mortgage? Do you get
Sure.
penalized?
You don't actually. You're accumulating a number of credits that are used towards paying the college tuition. If you aren't able to continue and get all the credits you need, that's okay. You just use the credits that you have purchased along the way. So,
That makes sense. That makes sense.
yeah.
So we can talk more about this, but I'd like to explore the other part of this. Now you have kids, you're done college. Now let's talk about how you help them retire early, or actually maybe not retire early, but save for retirement.
Right, right. The two topics kind of go hand in hand almost. It's all about planning, and it's the further in front of something you can get, the better, right? It's unfortunate when people come to me very, very close to retirement. In retirement, there's certainly things we can do to improve the situation, but if we just had maybe a little bit more time in advance, we could always do more. The Roth IRA is the only account I'm aware of in America where the earnings from that are tax-free at this point, unless Congress changes that rule, and that money left to beneficiaries when the person dies with the Roth IRA is also tax-free. If children are working 18 or over, they can contribute to that Roth IRA at that point. Now, they can't take any gains from that money out until they're 59 and a half. You would be penalized if you took gains out previous to 59 and a half. But just contributing that amount of money, and sometimes parents may want to reward their children. Maybe the child has a job. Parents will say, "Here, I will contribute on your behalf this amount of money to this retirement account." They're probably not that excited at 18 or 19 or 20 about that contribution, but they will be at 30, 40, and 50 when that money has grown substantially and they have a huge leg up. It takes a lot of discipline to save for retirement, and many people put that off. And unfortunately, many women that I've worked with are relying on their spouse to save for both of them.
Yeah.
So I've found that I was working with a local dental practice, of which almost all the employees were women, and few, if any, had any retirement program until I met with them. And so it was a real eye opener to realize having your own retirement money. Once you start saving, there's an inclination to continue to save and see it grow and get you more involved in your finances. So I think having kids at that age get involved in finance and in the stock market and investing instead of being this mystery. I gave a talk at the University of Florida, and somebody said, I felt like the stock market is this magical place, that they just have no concept of how it works. It might as well be another universe. We don't do a great job in this country of educating our students on personal finance or the stock market, or it's just it seems too complex. Like you won't get it. We don't have time to spell it out for you. It doesn't have to be that way. And so if you can get your kids involved, at least interested in it at an early age, that's going to pay dividends forever.
Yeah. So you had so many great points there, Adam. So first and foremost, I want to kind of go back. The reason people like you and I and some of our listeners and viewers tend to prepare for this is because we love our kids. Right? I would say most parents who become parents love their kids. I say most because, as you and I both know too, sometimes they just don't.
Sure.
And preparing for retirement, it's not really in front of mind when your child is just starting to go to college. But what a smart decision to gift them at about 18, 19, 20-year-old. And you're absolutely right. They are not going to be excited at that time. But 2 years or 10 years, 20 years later, it's a different story. It's a different story. And to think of it that way is super helpful for helping your child retire. And then the second piece that I want to talk about is, and you hit the nail on the head, we don't do a great job with financial literacy, real life financial literacy. We do good with the subjects that people need to, that our students need to learn. No doubt about that. We have some awesome universities in the state. However, as you know, the financial literacy bill was passed earlier this year. And actually, personally, this is very, very close to my heart because I do help with my NAFO people. We do try to get involved with junior achievement and help with the financial literacy of our youth. And you're right, the stock market is one of them. We need to educate the youth more about this. And I think FPA as well is going to get involved. So we do have the Financial Planning Association and the Insurance Association trying to help the Junior Achievement Association for that purpose. So hopefully you and I will have a conversation like this 10 years down the road. And we're going to look back and we're going to say, you know what, at least now some of our newer graduates are empowered to make some of these decisions. So I have one specific question about the Roth IRAs, especially when you said that, this dental practice that you work with, there's a lot of women and they don't really have their own retirement plan. So I don't think most people know that you can set up your own private retirement plan, that you don't have to have your employer set it up for you. Can you kind of shed a light on that for us, please?
Sure, that's right. And just a topic that came up that I was thinking about is sometimes, unfortunately, younger people and older alike are lured into what's hot right now, and that being cryptocurrency. And hear stories about getting rich very fast. I've rarely in my life seen that work out very well for anyone. As when the internet and technology bubble burst in March of 2000, I had people nearly in tears, who would put so much money into, pets.com or, you name it, website. And so you need to be part of financial literacy is understanding the risk involved. And that's a big part of it. But you're right. You don't have to have an employer sponsored plan to save for retirement. That's very true. A lot of people, though, are intimidated about starting their own retirement plan unless somebody kind of nudges them in that direction or helps them out, or they're relying on their spouse to handle everything. And they're missing out on a lot of opportunity from a tax perspective and from a savings perspective. You can always set up traditional IRA. Contrary to popular belief, anyone, regardless of income level, can contribute to a traditional IRA. It may not be tax deductible, but at least it will grow tax sheltered until you take some of that money out in retirement. Roth IRA has different limitations based on income. You could always convert money to a Roth IRA. I would check with your tax professional before you do that, because many people make a mistake and end up paying more taxes than they expected to when they convert some money into a Roth IRA. And that would also be taxable income, and people on Medicare, that may affect your Medicare payment. That becomes a surprise to a lot of people when their advisor recommends converting to a Roth, and they then find out their Medicare payment's gone up substantially. So.
I think, Adam, what you're saying is, and correct me if I'm wrong, is when you do these things on your own, you don't really have to do it on your own. You have to consult a professional, whether that's a financial advisor or your CPA or your attorney. It really does pay to go to someone who knows what they're doing to help you have the peace of mind that you're doing the right
enormously thing. The old saying, you don't know what you don't know.
That's
and
right.
People are often learn the hard way what they don't know. It's very easy to open these accounts online, but then once you try to figure out the tax implications of it, or Medicare payments, or what does this mean for beneficiaries, or my estate planning, then you're in a whole nother ballpark, and you really need to consult a professional.
Absolutely. So you hit some estate planning there, and let's talk about protection. Tell us your thoughts about protection. We talked about some growth, planning for the future for college, but what about the basic foundation of protection?
Sure. There's five different pillars, we call them, in my last profession, in my last job, and what I'm doing now in terms of what I offer as a financial, planner, and that is, and I'll talk about the protection area of it. There's retirement income, which most people are excited to hear about how much money they're going to have to spend in retirement, or maybe not excited, depending on what the results of the plan are. The asset allocation, how you're going to be invested, and to what level of risk are you going to be taking, and how that's going to work out over time. Then you also have the area of estate planning, which can be very complicated, and you're really going to have to engage an attorney.
Absolutely.
Who is going to receive this money when you die? Are they going to receive it in a tax efficient manner? And what's very important, if you're taking care of children or an older relative, will they be protected? Have you set up a power of attorney if somebody needs to work with you on your behalf, on your accounts? If you become incapacitated, if you don't have those documents in place before something happens to you or to a relative who's unable to make decisions, it's very complicated and expensive to then get those documents issued by the court to give you that authority. And then there's the risk management part of things, basically, and that's where you talk about protection, about life insurance, or long-term care. And then also maybe if you have an annuity, either at work, a pension, something along those lines, how does that play into your overall income strategy and risk management strategy long-term? But what I found out people usually are least prepared for is the estate planning. I think it's just human nature not to want to contemplate dying and the sadness that surrounds it and having to get your affairs in order. And I usually ask people, well, just give us a week or two before you die and we'll get it all done, and well, I don't know when that is. There you go. Yeah. Why don't we do that now? But the life insurance is another one. You have so many people who are drastically underinsured. And it's not just people with young children who want to cover college costs and the mortgage. There's more to it than that, especially if only one spouse is working. How do you expect this person to survive for 20, 30, 40, 50 years? Something should happen to you. So it's very important to make sure that is secured. It's one of the first things that's recommended by the Certified Financial Planning Board, is to make sure that somebody has life insurance in place adequate to support loved ones when they pass.
Absolutely. I always say that people who buy insurance, life insurance in particular, love someone or something else besides themselves, right? Because like you said, the question is, in your example, how does someone live 20, 30 years if you're the breadwinner and you pass away? And that is really, nobody likes to talk about it because nobody wants to face their mortality. Nobody likes to face reality. We'd like to think we're all Superman or Superwoman, right?
That's right.
Adam, this is very helpful. I'm going to pivot. Let's talk about some of the latest things that's happening, right? Market has been so volatile. There's always volatility, as we know. But tell us a little bit about why people shouldn't panic or should panic, or so tell us your thoughts about that, please.
Right, the panic button. What's really important when you're investing is that you've got a few things in mind. We have to ask all clients that are working with us, what are your liquidity needs? What kind of cash do you need, in the short term or medium term? It's basically, so what's your time horizon? And then what level of risk are you comfortable with? So, what pushes people's buttons is when they are taking more risk than they're mentally or psychologically able to handle. Because let's say some advisors or some financial professionals will show you a chart showing the rate of return for an aggressive portfolio, a moderate portfolio, and a conservative portfolio. And not surprisingly, the aggressive portfolio over time always wins.
Sure.
Unfortunately, that's the average rate of return over time, and it's not showing you the massive ups and downs of that portfolio, and then over the next 30 years. What happens when people who buy at a certain level and see substantial losses, especially if they're in retirement and can't replace that income, what do you think the inclination to do? It's to sell, right? I hear frequently, well, I don't think I can't lose this. I can't lose anymore. I can't. So then what may have happened is you may not have been invested properly for your level of risk, because that's people if you can't sleep at night, then you probably didn't have a very good plan to begin with. And your assets probably aren't allocated according to the amount of risk that you're comfortable with, which can be very hard for people, because once they sell, then what they do then is, I'm going to wait for the market to recover, which is amazing. So they're going to wait for it to go higher to buy in again. And I cannot tell you how many times I've seen clients do this over and over and over again. And so they are always behind the curve.
Right. And you know how hard it is to, first and foremost, when you are someone who's consistently looking at how your investments are doing, how your portfolio is performing, and the volatility is there, and not understanding that you can't time the market first and foremost. If you do, well, good for you, right? But a lot of people think, oh, this is high right now, I'll just keep riding it. Wouldn't that be the perfect time to do something about it instead of waiting until it's down and then now you're taking it at a loss? So, obviously you need to consult a financial advisor such as Adam. But what are your thoughts about that? Isn't that right? It's like very counterintuitive.
It's extremely counterintuitive that we buy high and sell low, and yet it just fits into that pattern. And you, of worrying about, well, if it's going to go higher, if it's high now, it's just going to keep going higher. For some reason, you have that euphoria that it's just going to keep going, like we did in the internet era. The internet's going to solve all our problems, and then it didn't, because none of these companies were really making any money, and they had jumped the gun on how this technology, when people didn't even have high-speed internet, was really going to be used at that time. And then you have a lot of people who are jumping on a bandwagon during the pandemic. There were certain stocks that did well that time period, and they rode those up, and many of those are down 60, 70, 80%. There's that hot stock mentality that can be very dangerous, and the risk associated with owning a single stock. Back in the day, you had the widows and orphans stocks like AT&T and Johnson & Johnson and Exxon Mobil, and that you could own that forever. And there's some, and the dividends would keep paying. And there's some truth to owning some of the stocks, but there's many others you could name that have gone away, or have decreased in so much in value, like your General Electric. You never would expect it to be where it's at. And forcing, and you trying as an individual to figure out the best time to buy and sell those stocks that's quite a task. I think the days of just set it and forget it are pretty much gone. And if you have a diversified portfolio that's balancing risk, and then you rebalance that portfolio when some of those investments exceed the amount of the portfolio that they should be in, then you're going to really reduce the long-term volatility of that portfolio. We want that channel of returns, the highs and lows, to be very narrow. We don't want them to be very wide, because then the odds are that you're going to have to sell at one of the low points. And to follow up on that, people who don't have enough money set aside are then forced to sell. They put themselves in that position. People often ask me, Adam, well, what would you have done this last year and a half? How would you have avoided all this? I said, well, almost everything was down. So if you didn't have a substantial cash position, you were going to lose money. But if you had a substantial cash position, then you didn't have to sell anything that was down. So if you do a decent analysis of what the client's cash flow is going to be over the next year, make sure that that's available to you, either in a money market or savings, or even short-term CDs or short-term treasury bonds, something that is liquid or will become liquid, then you don't have to worry about the day-to-day of the market. And technology now has that market in your face every day, where you know exactly how you're doing, and that can be a little nerve-wracking.
Absolutely. And to your point, really what I heard you say here, diversification is one of the key things to living a less stressful life when it comes to your investments, and looking forward to your retirement as it pertains to your investments. And in addition, matching the risk tolerance of the person, I believe, really makes a huge difference in the big picture.
Tremendously so. I rarely have anyone complain about, if the stock market was up 18, that they made 12%. If the stock market's down 30 and they are 20 and they absorbed all of that, that's when the people are like, that wasn't a good investment for me, even though they knew full well going in that there was a risk involved in being in a very aggressive portfolio. So it's definitely important to gauge how much risk someone's willing to take. You can ask them, how would you feel about a 10% loss or 15% loss? And you put it in real dollar terms. If they have $500,000, how would you feel if next year you had $400,000? And they might say, I don't want just to have 400,000. Well, then we need to make sure that you're invested properly. So we do our best to avoid you being at 400,000 next year.
So I'm curious personally, Adam, so would you rather have a more consistent small gains over about the long haul, maybe 10 years? Or, personally, are you more like, let's see, I want like maybe medium return here and higher towards the end of the 10 years. So what's your personal thoughts on that?
So it all depends on the age of the participant almost. What is your time frame? We talk about what's your time horizon. And if you're the miracle of dollar cost averaging, that if you're putting in a consistent amount of money each pay period, that when the stocks are high, you're buying fewer shares. When the stocks are lower, you're buying more shares. So over time, as the position improves, you do very well. It's called the miracle of dollar cost averaging. The fact that you're not buying as many shares when it's high, you're kind of acting in your own best interest. And when it's low, you're buying more shares, typically in a mutual fund that's in your retirement plan. And over time, you need to be careful that you are looking at the amount of risk that you're taking. Unfortunately, people who retired right before 2008 were about to saw just an unbelievable downturn in their portfolios.
Yeah.
That can be absolutely terrifying. There were so many people that actually had to work several more years than they expected to because they had lost so much money in such a brief period of time. It's very difficult to decide that you don't want to be in the market. And I might be different than many advisors where I don't feel like you have to be 100% or 98% involved in a stock, bond, real estate portfolio. I think there's definitely some time when you can stay in cash and not have that risk. But that's my perspective. It's difficult if you don't have an advisor. If you have an advisor at most large firms that has several hundred clients, who's not going to call 700 people with those or watch their portfolios that closely. So it's difficult to get that level of attention. So I understand why it's not something that's advocated. So
thank you for being candid and sharing your knowledge with us. I really appreciate it. We can talk about this for several more hours, but we don't have that time right now.
We don't. Well, all I would say is when you're doing a financial plan, is when you're moving along and you're getting within 10, 15 years of retirement, when you're incorporating expected Social Security payments and any sort of pensions or annuities that you might have, that's sort of guaranteed money. We could talk about Social Security as guaranteed money forever, but that sort of guaranteed money is something that you can use to reduce kind of the risk in your overall portfolio. Or maybe you could take a little bit more risk knowing you have that guaranteed money. It just depends on what your expenses are. So.
That's right. Very good point. And you can actually use those in so many different ways. Again, you have guaranteed money from a protection standpoint. That's really all what it is about.
Oh, and I would also advocate for people to please don't assume inheritance is guaranteed or that it's any huge dollar amount. I don't really look at inheritance really as a strategy. I've seen too many people either disappointed by the amount that they're going to get, or they get it much later in life.
Yeah.
And I'm not a fan of the inheritance strategy. That's my perspective. No.
And imagine being cut off at the end of your.
That's very true. Or
expectations.
Typically the person whose the last 3 years of their life is unbelievably expensive due to healthcare costs and assisted living costs. And they, 400,000 or 500,000, it just evaporates, which it can easily do. In this country, if you need a high level of care the last 3 or 4 years of your life, and there goes the inheritance. So.
That's right. Very good point, Adam. Very good point. Listen, if people want to get in touch with you, to have questions about any of the topics we talked about today, Adam, how do they do that?
They can go through my website, ACH Wealth, and then it's MGMT.com. You can contact me through the website there. There's links, send me an email. You can also email me directly at adam@achwealth.com. And you can always call me if you'd like. Area code is 352-614-1070.
Thank you, Adam. Always a pleasure chatting with you. Thank you so much. I appreciate you joining us today.
Thanks for having me. It was great.
All right. Bye.
Bye.
Information shared during the show are opinions of the speakers. They are not legal, financial, or tax advice specific to you. Consult your own specialist, attorney, accountant, financial planner, or insurance advisor for your specific situation.